Welcome to Accenture's Insurance News Analysis. I'm Abby Compton here with Kenneth Saldanha, Accenture's Global Lead for Insurance. We'll be talking about what's making news around the industry. Well, $73 million in claims will be paid to families who lost loved ones in the Sandy Hook school shooting. The victim's attorney called on gun makers and their insurers to consider ways marketing can help reduce risk rather than court it. Kenneth, do you think underwriters will be looking more closely at marketing practices of potentially dangerous products? And is this really more than just a marketing problem?
Well, it's definitely more than a marketing problem, Abby. I mean, we're in the midst of an enormous kind of social responsibility problem, and I think insurers are keenly aware of the role they play with the ESG agenda right now, more so than ever before. Now, the notion of products and products liability is not a new thing, and this being applied to guns is certainly not is going to be an extension of what's been done so far. If you look at what's playing out, we are going to see more and more of this as we see more and more technology and productization and AI ML playing out. You can imagine, just like we have on the products liability of guns right now, we're going to see some of that play out even on things like auto insurance as liability shifts from, was it the driver to was it a self-driving vehicle? So I think insurers are keenly aware that as we look at more and more products playing kind of a role in what is being insured as opposed to the individual behind those products, I think we're going to see a big shift there. And it's going to be, I think, fairly endemic across the industry because it isn't, certainly right now, the gun liability is front and center in its attention. I would imagine we're going to see that play out again and again with, self-driving vehicles, with alarm systems that are meant to mitigate risk in homes. All of these things are going to continue to play out. And so, there's often a discussion of saying, is this, are we going to see a disruption of the industry because we won't have claims anymore because certain products get blocked or certain technologies come into play? I think what we are more likely to see is exactly this kind of situation where liability starts to shift in terms of where it resides. And right now, there's a stronger push for liability to reside on the products. But it comes with, I think, a very important message to insurers across the board saying there will be heightened visibility and liability for the products that are coming out of their policies. So I think underwriters are keenly aware of it. I think they've been seeing that trend for a while. It's not a new trend. It's not a new feature to have products liability. But I think the scrutiny is certainly increasing. And because of the ESG element of this and the social responsibility around these issues, I think that has certainly got a much higher light turned on it right now.
Well, Kenneth, in your latest blog post, you referenced the metaverse and how insurers are beginning to prepare for its inevitable expansion. One impact we're already seeing is a jump in claims from gamers damaging their own property while wearing VR goggles. So how should insurers go about underwriting risks that breach the metaverse?
So this is an interesting situation, Abby, because we're now in a place where literally the consumers of what's happening aren't necessarily fully aware of how it's going to play out, right? And so as a parallel, as a distant parallel, let's start with when we saw in many developing countries, when you first start to see an explosion in the number in auto ownership and car ownership, typically the frequency and severity of auto accidents is much higher than in countries where it's been around for a while. So whereas, to put a number on it, you might see 12 and 15% frequency in the countries that have had auto insurance for a long time, when you looked at frequency and severity in countries like China and India, when car ownership really exploded in the last 15, 20 years, you were seeing frequencies in the 40% range, right? So essentially, instead of 1 in 12 people having an accident, 1 in 2.5 people having an accident, because it's a new product, it's a new social phenomenon. So I think we're going to see higher incidence of claims. We're going to see new kinds of losses, probably some high severity in terms of the cost of those claims, because it is brand new behavior. And so, it's not an entirely new dynamic for the insurance industry to see, a new social behavior or a new kind of product to hit the market, it does take time for those things to stabilize. This one, is again, it's not a physical product. It's not a new car or thousands of new drivers hitting the road at the same time, but it is thousands of new users hitting the cyberspace implications of this at the same time. And we'll have to see how many accidents they have. But I think it'll be higher than it's been so far.
Well, California announced new rules that would reduce premiums for homeowners who make their homes more fire resistant. We've talked a lot about insurers working with their customers to help mitigate risk. Now, here's an example of a regulatory agency getting involved. Do you think more regulators will do the same as property insurance prices rise?
So I think that the spotlight on property as homeowners insurance, renters insurance, property, commercial property in general, I think is a reflection, Abby, certainly of what we're seeing in the extreme pressure on that segment, as you and I have talked about in prior discussions. Right, we do think that this is going to be a key area of focus for the industry this year. Now, I don't think that the regulators adding this as something that they're watching is going to make a dramatic difference to pricing, simply because if you look at most homeowners or renters policies, as I'm sure you've seen from your own experience, there's still questions about whether you have a burglar alarm system, how far are you, from a fire hydrant, how far are you from emergency services, but also, do you have smoke detectors? Do you have ways to do temperature checks? And all of the new products, like the Nests of the world, have those features and are explicitly targeting those as ways for you to limit your insurance cost. So the fact that regulators are now saying you have to do that, I think is interesting, but I think most carriers who are competing for the business today are offering that up because they recognize that risk mitigation is highly valued. Not only is it in the baseline policies by asking those kinds of questions, but if you look at some of the fire situations, the catastrophic storm situations, the fire situations, you've always seen insurers reaching out to customers, asking them to spray fire retardant foam on their houses, to do even simple things like park your cars on higher ground, don't park them at the bottom of a hill. So there's risk mitigation both at the policy level that's always been in place, and there's risk mitigation on the claim side when you've got foreseeable catastrophic events of how to prevent that. So I think this is a place where certainly regulators getting into the mix can't hurt, but I suspect carriers have already been putting these in place for quite a while, because there is a recognition that it is a price competitive sector, right? Homeowners and renters, as even commercial property, as with all insurance, I would argue, is a price sensitive sector. And I think insurers have been moving on this space for quite a while.
Okay, Kenneth. Well, it's always great to talk to you and to get your perspective on what's happening in the industry. Thanks for your time.
Thank you, Abby. Talk to you soon.